Welcome to the Probable MCQ series for BFM, and we are covering the objective questions, main objective questions which can come in exam. So follow the video till the end. Let's start without wasting the time, because as the exams are near, you don't have time, right? Isn't it? Chalo, let's start. Yesterday I've given you one homework. In financial markets, bond prices and yields are. So in financial markets, what happens? These bond prices and yields are what? Inversely or directly proportional? Okay, let's remove these remaining two answers. Okay, D, C and D out. Okay, let me directly come to the point. Inversely related, directly related. Yes. So bond prices and yields are what? Directly or inversely? We have studied this in CAIIB, right? So it is inversely. Always remember, if the bond prices are up, the means basically its yields are up, bond prices will be down. It's like this here. I'll give you a simple complete theory about this. Okay, if the yields are up, okay, then what happens? What all goes up? Okay, first what all goes up is this inflation goes down. Inflation goes down. Okay, once the yields start rising up, the inflation is in control, but GDP goes down. GDP, that also goes down. So that's the negative part. Okay, prices of the bonds go down. Prices they also go down. Okay, so one only interest rate up, what happens? Look at this. All these three elements go down. Inflation down, GDP down, prices down. So what is a good thing? Say, inflation down is a good thing for the common public, right? But GDP down is a bad thing for the common public. So that's why it has to be balanced. Always remember, the yield and the prices of the bonds are inversely proportional. Okay. The rise on the stock portfolio, which cannot be, the risk on the stock portfolio, which cannot be eliminated or reduced by placing it in diversified portfolio, is classified as. So which is the risk which cannot be eliminated by putting it in this portfolio analysis portfolio? What does this mean? It means that, look at this. Suppose if I invest in one share, let's say TCS. I invest in TCS. Okay, let me make this yellow. This red is not looking that good. Okay, yeah. So if I invest in TCS, let's say 1 lakh rupees, 1 lakh. And what happens? This TCS goes down. Let's say I've invested it at 2000, and now if it goes down from 2000 to 1500, so what will happen? I'll lose 500, okay, per share, and 1 lakh I've invested. So whatever it is, 50 shares I might have brought, right? So 50 into 500, right? So that much I'll lose. 5 5 are 25,000 I'll lose roughly. But if I invested in this instead of TCS, I invested in mutual fund. So what does the MF do? MF will invest in hundreds of shares. Okay, one is TCS, others are also there. So if TCS goes down, there are other shares like Reliance, HDFC Bank, ICICI Bank, SBI, all these banks, Federal Bank, PNB Bank, all these shares. So there are thousands of other shares. So what happens because of this? Even if one share goes down, remaining shares are up many a times. So that's why your portfolio is adjusted. But the question over here is something different, which cannot be eliminated. Means either if I invest in TCS or if I invest in mutual fund, the risk which cannot be this eliminated is what? Diversifiable, market, stock and portfolio. So the answer is market risk. It cannot be eliminated at all. You invest in this mutual funds, you invested in shares, you invest in gold, you invest in any other bonds, right? Market risk cannot be eliminated. What is market risk? Market risk means that risk which comes from the external events, which is not in your hands. Okay, risk associated with the portfolio is always less than the weighted average risk of the individual items in the portfolio. Due to, so this is due to what? Diversification of risk, the fact that all accounts in the portfolio will not behave in the unidirectional manner, the fact that all the risk in the account in all the accounts in the portfolio will not materialize simultaneously, and both A and B. So it is what? Diversification of risk. Correct, that is the point. Because of diversification of risk, the risk of the portfolio will always be less than the individual item. Okay, diversification is the answer, A is the answer. But what about B? The fact that all the accounts in the portfolio will not behave in the unidirectional manner, that is also the point. Just now we saw it, right? What did we see over here? See this. In this we saw one important part, that was investing in TCS and investing in mutual fund. Mutual fund consisted of many shares like TCS, so that's why all of them won't move down if TCS moves down, so not in unidirectional manner. So the answer is A and B. Okay, so this is the real answer, D. Before going ahead, download Adda 24/7 app on your mobile. In this app you'll be getting the premium study material plus live classes, ebooks, tests, everything. Whatever you need you'll be getting it over here. Okay, so download it right now. Aggregate risk of all stocks together as a whole is called as what? Transaction risk, portfolio risk, total risk, none of these. Very simple one. So it is called as what? Transaction, portfolio. Okay, let me give some hint. Total risk is out, none of these is out. So it is either transaction or portfolio. So what is the answer? It is portfolio, correct? All stocks together, that is portfolio. Transaction risk means what? Transaction means when I do the transaction, it's an individual level transaction point. Okay, when I give the loan, that's a transaction. Okay, a portfolio consists of all stocks in the market as all stocks in the market is classified as what? Market portfolio, return portfolio, correlated portfolio, or diversified portfolio. All stocks. Now here, remember this word, all stocks. All stocks means everything, whatever is there in the stock market, everything is included over here. So that's but obvious, which stock, which portfolio? Market, return, correlated, or diversified? It is diversified. Diversified means what? See this, all stocks means there are various sectors of stocks. Let's say oil sector, gas sector, then metals, then banking, then finance, okay, then IT, then FMCG, then cement. You name the sectors, it goes on and on and on everywhere. Gold is also one sector. So stocks are there for all, so that's why it's called as diversified. Okay, in asset portfolio the number of stocks are increased to. Why do I increase the number of stocks in any asset portfolio? The number of stocks are increased to reduce the return, reduce the average, reduce the risk, increase the prices. So what happens? Suppose, let's say one example, I am having a portfolio. Okay, portfolio. Okay, now let's say there are 10 stocks in this, 10 stocks, and what do? I invest around 1 lakh rupees in this, 1 lakh. Okay, so what happens now? When I invest 1 lakh in that portfolio of 10 stock, if I divide it averagely to all, what happens? Each stock will get what? Each stock will get 10,000, 10k, I'll write it. Okay, now same portfolio, I increase the stocks from 10 to, let's say, 20. So 20 stocks now, same 1 lakh invested. So how much will each one get now? 5k, right? So what has happened now in this? Earlier I was investing 10,000 in one stock, now I am investing 5,000 in one stock. So tomorrow if that stock goes down, what happens? What reduces? My risk reduces, right? The risk of downside reduces. So the number of stocks are increased to reduce the risk. But remember, in any portfolio, you should not go on increasing the commodities, not only stocks. See, this stock is just one commodity. I can have bonds also. You should not go on increasing those many bonds, those many stocks, those many commodities which are unable, which it will be difficult for controlling. Okay? Before going ahead, subscribe to Officers Adda 24/7 YouTube channel. In this channel, number one, remember, you'll get the latest videos, YouTube series on all the subjects, all compulsory plus elective. Click on the bell icon. Number two, you'll get the latest updates on JIB and CIB. Whatever comes from IIBF, you'll immediately get it. Okay, so subscribe to it. Click on the bell icon. Mostly in financials, the risk of the portfolio is smaller than that of the assets. Mean weighted average, mean correlation and negative correlation. So the risk of the portfolio, always remember the portfolio risk means what? The risk of the entire gamut of the funds, these stocks or commodities which I am having, that will always be less than what? Mean or weighted average or mean correlation. Okay, I'll give you a hint. Remove this correlation, remove this negative correlation, either mean or weighted average. We saw it in the second question, just now in this series only, just now, this lecture only. I gave you a hint over there, that is weighted average. Okay, always remember, weighted average is always calculated for calculating the portfolio or designing the portfolio. There are various types of weighted averages: moving weighted average, EMA, exponential moving average, double exponential moving average, various moving averages are there. So these are called as weighted averages, and that is the basic key of any portfolio. What is the advantage of this weighted average here? The advantage of weighted average is the latest figures. Look at what am I saying? The latest figures or the latest data will get the prime importance as compared to the earlier data. That is the advantage of weighted average. Which of the following statements is correct? So which is correct? Let's see. The funding risk may arise from the need to replace net outflows due to unanticipated withdrawals of deposits. So funding risk may arise due to unanticipated withdrawals. Let's keep it that simple. Unanticipated withdrawals, if they are there, then I'll be requiring the funding. Okay. So is this correct? Yes, it is correct. Because if all the depositors come to my branch tomorrow for withdrawing the funds, where will the funds be? So that's why we have RBI has placed what? That's called as LCR, right? Liquidity coverage ratio, Basel 3. Okay, it takes care of this unanticipated withdrawals. Second, time risk arises when the performing asset turns into NPA. But obvious. Time risk means what's here? What do you mean by time risk? Time risk means the time at which I need the funds, I don't get it. So if my loan becomes NPA, what happens? The interest which I was to get from that loan, I don't get it. So no interest means no income. No income means time risk. Okay, so that is also correct. Call risk arises due to crystallization of contingent liabilities. So what are contingent liabilities? Contingent liabilities means those liabilities which are to come in future. Like, let's say bank guarantee. Suppose if my bank gives a guarantee on behalf of any customer, let me write it properly. Guarantee, okay, on behalf of any customer, then what does it mean? This is my customer A, okay. This is, let's say, state government, okay. Now this my customer wants to build a bridge. He is a contractor, okay. He or she, it's not gender biasness. So he or she is a contractor. He wants to build a bridge for the state government, but state government asks for the guarantee, so I give the guarantee on behalf of this A, okay, on behalf of this A, okay. Now what happens? This A does not build the bridge, or if he builds it wrong, okay, or some error he has made. So state government, what will it do? It will bring that guarantee to me and ask me, I am the bank, and ask me for the payment. So that is known as crystallization. Whenever the future liability, this is actually non-funded. So whenever this non-funded liability is to be converted to funded, so at that time it is called as crystallization. So that is C. So all of these is the answer. All of them are true. Okay. The features of interest rate risk are. So what are the features of interest rate risk? It is an exposure of bank's financial condition to adverse movement in the interest rates. It has a direct effect on net interest margin. It may also affect the market value of the equity, and all of these. What should be the answer? Exposure of bank's financial condition to adverse movements. Adverse movements means due to the interest rates, what happens here? Understand one basic problem. Interest rate risk means what? If the interest rate goes up constantly, then what happens? It is good for the loans, but it is bad for the depositors. If it goes up, it is good for the depositors, but it's bad for the loans, right? Reverse thing. Okay. So let's say interest rate up. Let me explain. Okay. Interest rate, if it goes up, up. Okay, so loans as a banks here, now there are two angles to this. Okay, deposit. Okay, so interest rate up means both the rates will be up, loan also up and deposit also up. So what happens in this case? If the loan rates are up, then who will be happy? I'll write this table over here. Happy. Who is happy over here? So it is bank. Bank is happy because bank will earn more income. But who will be sad? Sad will be the customer, right? Because he will have to pay higher interest, right? But what about this deposit? Who will be happy? Customer will be happy. Your customer is happy because he will get more interest. And who will be sad? Bank will be sad because bank will have to pay higher interest, right? So what is interest rate risk? It means adverse movement. Adverse movement means what's here? It depends on whether I am talking of loan or whether I am talking of deposit. So if I am talking of loan, okay, if the loan rate goes down, then also it's an adverse movement. If I am talking of deposit, if the interest rate goes up, then also it's an adverse movement from the bank's perspective. I am talking only from the bank's perspective. Okay, so it is an exposure of bank's financial condition to adverse movement in the interest rate. So that is true. It has direct effect on NIM. So it will have, definitely. NIM means what? If the interest rate goes up, deposit rates will go up. Loan rates will also go up, but there is a competition then. If the deposit rates go up, then due to competition I'll have to give extra deposit rate. And I'll have to give lesser loan rate due to competition. So competition kills this NIM. So it will have an adverse movement. It may also affect the market value of the equity. Correct. If my NIM goes down, net interest margin goes down. So my profit goes down. My profit goes down means the value of my share goes down. So the answer is D, all of the above. Isn't it? One for your homework. The portfolio which consists of perfectly positive correlated assets has no effect of. So if they have perfectly positive correlated assets means what? What do you mean by perfectly positive? Okay, firstly understand this concept, perfectly positive. Okay, let me make it red now because the background is white, so we'll make it red. Okay, so perfectly positive means what? Let's say correlation and regression. You studied in this ABM. Correlation. Okay, you studied R. What is R? R equals to 1 means perfectly positive. R equals to minus 1 means perfectly negative. R equals to 0 means no relation, right? So this is the question over here. If R equals to 1, perfectly positive, then it has assets having no effect of negativity, positivity, correlation and diversification. So which one of these will be correct? No effect of this. Search it. I'll give the answer later. Okay, type in the comment section. Okay, now the two batches. See this Powerpack revision batch and video courses batch. You can join either of these. See, your days are very less, so you have to join one of them because the portion is new, subjects are new, and we are covering all the important topics. Everything is covered. All the 4 subjects are covered, compulsory ones. Okay, so join it ASAP. Okay, now let me show you how to join this. Here, use the code. Code will give you huge discount. So which is the code? See this. I'll show you. You can use the June 75 code over here. Okay, let me go to Adda 24/7. See this. On June 75 code, if you use, let me go directly. If you have the app, go through the app. I would suggest. Okay, click on the first page, JIB and CIB. Click on CIB 23. You'll see the details. Look at this. CIB Powerpack revision batch. Click on this. See here, the batch has already started, but the point is you have recorded videos available. So if you miss out on anything, you can definitely get back to it. Okay, study plan is given, details are given, everything is available. Okay, now look at this price. Okay, 75% off. See here, June 75 code is applied, so it's already applied. You can just buy now and click your details. Okay, put the code again, June 75 if you want. June 75. Okay, click on apply. Look at this, then continue. You'll get the details how to make the payment. See this, only 3 steps: apply, fill and payment. Similarly for video courses also, you can join the video courses batch also. Okay, in video courses batch, check this. See this, CIB 23 again. Click on this video courses, scroll down, you'll see this video courses batch. Click over here. You'll see the details, all the details. Read it at your ease. All the subjects are covered. Numericals, objective questions, everything is covered. Now look at this fees part. 5749. June 75 code. Okay, June 75. Put this June 75. Click on apply. Look at this. 22999 reduces to 5749. Use discount. Go for it. Okay, because exams are near and you have to clear it this time. Okay, don't wait for November series. Okay, so I'll be back tomorrow with another series, another studies. Okay, till then, bye.